Imagine it's October 2019. You're a 38-year-old software engineer named Hassan living in Beirut's Hamra district. You have $140,000 in a dollar-denominated savings account at one of Lebanon's largest banks. You have a mortgage on a two-bedroom apartment. You have a car loan, a good salary, and a retirement plan through your employer. You also have something that most people in the Middle East don't have: confidence in your banking system. Lebanon's banks have operated continuously through a 15-year civil war, through Israeli invasions, through assassinations and political crises. The Lebanese pound has been pegged to the dollar at 1,507 since 1997. Your bank pays you 6 to 8% interest on dollar deposits, more than any American or European bank would offer. You've been told this is because Lebanon's banking sector is the strongest in the region. On October 17th, protests erupt across the country. Within days, the banks close. When they reopen, you discover you cannot withdraw your own money. Not because the bank burned down, not because there was a robbery, because the rules changed. You can withdraw $200 per week, then $100. Then the bank offers you a deal: withdraw your dollars, but convert it to Lebanese pounds at the official rate, which is a fraction of the black market rate. Your $140,000 becomes, in real purchasing power, roughly $15,000. You sit in your apartment and try to understand what happened. And over the following weeks and months, as you piece together the timeline, you realize something sickening. Every lie you were told, every reassurance, every official statement, every central bank press release was a lie that has been told before, not once, not twice, in every economic collapse of the past century. The same 5 lies, in the same order, almost word for word. This is not a story about Lebanon. Lebanon is just the most recent example. These lies have been told in Weimar Germany, in Argentina, in Zimbabwe, in Greece, in Venezuela, in the Soviet Union, in Japan, in Cyprus. They have been told by democracies and dictatorships, by left-wing governments and right-wing governments, by central banks considered among the most sophisticated in the world. The lies are not random. They follow a pattern. They appear in a sequence, and they serve a function, not to inform the public, but to delay panic long enough for the underlying mathematics to become irreversible. Let me show you the 5 lies, not as theory, but as autopsy. Before we go through the lies themselves, it's important to understand something about why they're told. Because most people assume government lies are about malice or corruption. Sometimes they are. But in the case of economic collapse, the lies are usually structural. They are built into the incentive architecture of the system itself. A central bank governor who admits publicly that the currency is failing triggers the exact bank run that accelerates the failure. Truth is self-defeating in this context, so lying becomes policy, not personality. The people delivering the lies often believe them, or at least believe a version of them. Treasury secretaries and finance ministers are trained to project confidence. It is literally their job description. When Janet Yellen said inflation was transitory in 2021, she may have believed it. That doesn't change the fact that it was the same word used in Weimar Germany, in Argentina, in Venezuela. The sincerity of the liar does not change the function of the lie. The lies work because they exploit a specific psychological vulnerability: normalcy bias. The tendency of people to believe that because things have been stable, they will continue to be stable. The lies don't need to be convincing. They just need to be plausible enough for people who desperately want to believe them. The cost of the lies is always paid by the same people: the middle class. The wealthy have information networks, access to foreign jurisdictions, and financial advisors who read between the lines. The poor have little to lose. The middle class has everything in the system and takes the lies at face value because the alternative, that their entire financial life is built on a failing foundation, is too psychologically expensive to accept. The first lie is always the same. In every language, in every decade, on every continent, this inflation is temporary. In 1921, German inflation was running at roughly 100% per year. The Reichsbank president, Rudolf Havenstein, publicly stated that the inflation was a temporary consequence of war reparations and would stabilize once foreign exchange pressures eased. He continued saying this in 1922, when inflation reached 1,000% per year. He was still saying it in October 1923, 1 month before the mark reached 4.2 trillion to the dollar. Havenstein died of a heart attack on November 20th, 1923, the same week the Rentenmark was introduced to replace the currency he had destroyed, while insisting the problem was temporary. He didn't lie out of malice. He lied because admitting the truth, that the Reichsbank's own money printing was causing the inflation, would have required him to stop printing. And stopping printing would have meant the government couldn't pay its bills. The lie was cheaper than the truth, until it wasn't. Argentina has experienced double-digit inflation in 40 of the past 50 years, and in every single cycle, the government has called it temporary. In 1989, Economy Minister Juan Surui insisted that the Austral Plan had inflation under control. Inflation that year reached 3,079%. In 2018, President Macri's central bank chief, Federico Sturzenegger, assured markets that inflation targets of 15% were achievable. Actual inflation, 47.6%. Sturzenegger resigned. In 2023, Economy Minister Sergio Massa ran for president while presiding over 142% annual inflation, claiming it was peaking and would decline. It accelerated to over 200% after the election. Argentina is valuable because it shows the lie is not a one-time event. It is a chronic condition. The same lie is told every cycle because it works every cycle until it doesn't. In 2013, Venezuelan Finance Minister Nelson Morantes stated that inflation of 56% was manageable and would be addressed through price controls. Price controls were imposed on hundreds of basic goods. The result? Shortages. The shelves went empty not because goods didn't exist, but because producers couldn't sell them at a price that covered costs. By 2015, inflation was 180%. The government stopped publishing official inflation statistics entirely. When you can no longer sustain the lie with words, you sustain it with silence. In June 2021, Federal Reserve Chair Jerome Powell described rising inflation as transitory. Treasury Secretary Janet Yellen echoed the word repeatedly throughout the summer. Transitory was used in official Federal Reserve communications 419 times between January and November 2021. By November 2021, Powell retired the word, stating it's probably a good time to retire that word and try to explain more clearly what we mean. CPI peaked at 9.1% in June 2022, the highest in 40 years. If inflation is measured using the methodology the Bureau of Labor Statistics used in 1980, before hedonic adjustments, geometric weighting, and substitution effects were introduced, the 2022 figure was closer to 15 to 18%. The government didn't change the definition of inflation. It changed the definition of measurement. The effect is identical to the lie, but it's technically not a lie. It's methodology. President Erdogan insisted that high interest rates cause inflation, the opposite of mainstream economic theory, and fired 3 central bank governors in 2 years who disagreed. Official inflation in 2022, 85%. Independent economists estimated the real figure at over 120%. The Turkish Statistical Institute changed its methodology multiple times during this period, each time producing lower numbers. A university research group, ENA group that published independent inflation calculations, was investigated by the government. When the lie can't be sustained by the liar attacks the people who tell the truth. This is a late-stage symptom. The mechanism is not deception for its own sake. It is delay. Every government that has ever faced accelerating inflation has understood at some level that admitting the permanence of inflation triggers the very behavior that accelerates it. If the public believes inflation is permanent, they spend faster, hoard goods, demand higher wages, and flee the currency. Each of those responses makes inflation worse. So the government lies, not to deceive, but to buy time. The lie is a dam. It holds back panic, but the water keeps rising behind it. And when the dam breaks, the flood is worse than it would have been if the water had been allowed to flow gradually. Every government believes it will use the time the lie buys to fix the underlying problem. None of them do, because the underlying problem, spending more than you earn, printing money to cover the gap, is politically impossible to fix. The lie is always easier than the solution. So the lie continues until reality makes it unsustainable. And by then, the damage is irreversible. The second lie arrives shortly after the first. Once inflation becomes visible, governments shift from it's temporary to, but the currency itself is strong. This is the lie about the container, not the contents. The purchasing power may fluctuate, they say, but the fundamental structure is solid. In November 1964, Prime Minister Harold Wilson declared, "The pound in your pocket has not been devalued." He said this on the day the pound was devalued by 14.3% against the dollar. This is perhaps the most literal example of the lie in recorded history. The currency was devalued, and the head of government went on television and told citizens it hadn't been. Wilson's reasoning, the devaluation affected international exchange rates, not domestic purchasing power. This was technically arguable and practically false. Import prices rose immediately. Living costs followed within months. In 1991, Economy Minister Domingo Cavallo established the convertibility plan, a legally mandated one to one peg between the Argentine peso and the US dollar. The peg was written into law. It was not a policy choice. It was presented as a structural guarantee. The government marketed it as the permanent solution to Argentina's inflation history. For a decade, it worked. Inflation disappeared. Foreign investment flooded in. Argentina was celebrated by the IMF, by international economists, by the financial press. By 2001, maintaining the peg required borrowing dollars the country didn't have. On January 6, 2002, the peg was abandoned. The peso fell from 1-to-1 to roughly 4-to-1 within months. People who had saved in pesos, who had been told that a peso was a dollar, lost 75% of their purchasing power. The legal guarantee meant nothing. The law was simply changed. The Lebanese pound was pegged to the dollar at 1,507 since 1997. For 22 years. This wasn't a soft peg. It was the foundation of Lebanon's entire economic model. Banks offered high interest rates on dollar deposits funded by the differential between the peg rate and real economic conditions. Central Bank Governor Riyad Salameh was named Central Banker of the Year by Euromoney magazine in 2006. The peg held through wars, assassinations, refugee crises, and political paralysis. It held so long that an entire generation of Lebanese grew up believing the pound was worth 1,507 to the dollar. Not that it was pegged, that it was worth that. In 2019, the parallel market rate began diverging. By 2023, the pound traded at over 90,000 to the dollar on the black market, a 98.3% loss of value. Salameh was later charged with embezzlement, money laundering, and fraud by multiple European countries. The peg didn't fail because the economy collapsed. The economy collapsed because the peg was a lie, maintained by accounting that would have been criminal in any other context. In 2006, the Reserve Bank of Zimbabwe redenominated the currency, removing 3 zeros. Governor Gideon Gono stated this would restore confidence and facilitate transactions. In 2008, they removed 10 more zeros, then 12 more zeros. 3 redenominations in 2 years, each one accompanied by official statements that the currency was stabilizing. The final Zimbabwe dollar note issued was the $100 trillion bill. It could buy approximately 3 eggs. The lie here wasn't about the peg, it was about the denomination. Each redenomination was presented as a fresh start. Each one was actually an admission of the previous lie's failure. The Thai baht was pegged to the dollar. The Bank of Thailand spent $23 billion of its $29 billion foreign reserves defending the peg in the months before the Asian financial crisis. Finance Minister Amnue Viravan resigned in June 1997 after failing to defend the peg. His successor held it for 1 more week, then abandoned it. The baht lost 50% of its value in months. The crisis spread to Indonesia, South Korea, Malaysia, the Philippines. The Bank of Thailand spent nearly its entire national savings defending a lie for approximately 4 months. The mechanism here is what economists call the impossible trinity, but what ordinary people experience as betrayal. A government cannot simultaneously control its exchange rate, allow free movement of capital, and run an independent monetary policy. It can do 2 of 3. When it claims to do all 3, it is lying, and the lie is sustained by burning through foreign reserves. When the reserves run out, the lie collapses in a single day. The cruelty is in the timing. The longer the lie holds, the more people trust it. The more people trust it, the more they commit to it, taking out loans denominated in the pegged currency, saving in accounts that assume the peg is permanent, making life decisions based on a price that is artificial. And then, in one announcement, usually on a Friday evening or over a holiday weekend, the peg is abandoned and every decision made in reliance on it is retroactively destroyed. The lie doesn't just fail, it punishes everyone who believed it, proportional to how much they believed it. The third lie protects the most critical piece of infrastructure in any modern economy. The lie is that your bank is safe, that your deposits are there, that the number on your screen represents actual money that actually exists. In January 2013, Cypriot President Dimitris Christofias publicly assured citizens that Cypriot banks were sound and that deposits were safe. On March 16, 2013, the Eurogroup announced a bail-in. Deposits above 100,000 euros at Laiki Bank were effectively wiped out. Deposits above 100,000 euros at Bank of Cyprus were converted. 47.5% of the amount above the threshold was seized. This happened on a weekend. Banks remained closed for almost 2 weeks. ATM withdrawals were limited to 100 euros per day. The money didn't leave the country. The rules changed while the banks were closed. When the doors reopened, the deposits had been partially confiscated under a legal framework that had been drafted in the preceding 72 hours. On March 11, 2008, SEC Chairman Christopher Cox stated, "We have a good deal of comfort about the capital cushions at these firms at the moment." 5 days later, Bear Stearns collapsed and was acquired by JP Morgan for $2 per share, down from $170 a year earlier. On September 7, 2008, Treasury Secretary Hank Paulson placed Fannie Mae and Freddie Mac into conservatorship while stating the banking system was sound. 8 days later, Lehman Brothers filed for bankruptcy, the largest bankruptcy in American history. The next day, AIG required an $85 billion emergency bailout. In the space of 6 months, multiple senior government officials stated the system was stable, and in each case the statement preceded a collapse by days. In June 2015, Greek Finance Minister Yanis Varoufakis stated that capital controls were unnecessary and that the banking system had sufficient liquidity. On June 28th, the government imposed capital controls. Withdrawals limited to €60 per day. Banks closed for 3 weeks. An estimated 40 to 80 billion euros had already left Greek banks in the preceding months, withdrawn by people who didn't believe the lie. The people who did believe it were trapped. Hassan's bank continued operating. The logo stayed on the door. The website still worked. He could log in and see his balance, $140,000. The number was still there. The money was not. The Lebanese banking system performed what might be the most sophisticated version of this lie in history. They maintained the appearance of banking while the substance of banking had ceased to exist. Your account showed dollars. The bank did not have dollars. The central bank did not have dollars. But everyone continued to pretend because the alternative was admitting that the system had been insolvent for years. Soviet citizens had savings accounts in Sberbank, the state savings bank. These were denominated in rubles. The accounts were guaranteed by the state. In January 1991, President Gorbachev issued a decree withdrawing large denomination ruble notes from circulation with 3 days' notice. Citizens could exchange limited amounts. Savings above the limit were effectively frozen. When the Soviet Union dissolved, those ruble savings were rendered nearly worthless by hyperinflation. The state that had guaranteed them no longer existed. The guarantee and the guarantor disappeared simultaneously. Iceland's 3 largest banks, Kaupthing, Landsbanki, and Glitnir, had assets worth 11 times Iceland's GDP. All 3 collapsed within a single week in October 2008. Foreign depositors, particularly British and Dutch citizens who had been attracted by high interest rates at IceSave, an online arm of Landsbanki, lost access to their funds immediately. Icelandic domestic depositors were protected. Foreign depositors were not. The government made a choice about who to save and who to sacrifice. The depositors who were sacrificed had been told the system was safe. The mechanism is fractional reserve banking itself. Your bank does not have your money. It has approximately 3 to 10% of it, depending on the jurisdiction and the regulatory framework. The rest has been lent out. This is not a conspiracy. It is the stated, legal, published structure of modern banking. In normal times, this works because not everyone withdraws simultaneously. In a crisis, everyone withdraws simultaneously. And when they do, the mathematics of fractional reserve banking produce an inevitable result. The bank cannot pay, not because it was dishonest, because it was designed to be solvent only under normal conditions. The lie is not that any individual bank is safe. The lie is that the word deposit means what you think it means. You think it means my money, stored for me, available when I want it. What it legally means is an unsecured loan to a leveraged financial institution that is solvent only as long as confidence is maintained. Those are not the same thing, and the gap between those two meanings is where bank runs live. The fourth lie is the most psychologically powerful because it's the one people want to believe. It's the lie that says what happened in Argentina, in Zimbabwe, in Greece, in Venezuela, that can't happen here. We are different. Our institutions are stronger. Our economy is more diverse. Our central bank is independent. We are not like them. In the 1990s, Argentina was the poster child of the Washington Consensus. It had privatized state industries, liberalized trade, pegged its currency to the dollar, and attracted massive foreign investment. The IMF praised Argentina. International economists held it up as a model for developing nations. Argentine citizens were told, by their own government and by international institutions, that the old Argentina of hyperinflation and instability was gone. The new Argentina was modern, stable, integrated into the global economy. In 1998, President Menem stated that Argentina would soon join the First World. 3 years later, the economy collapsed. 5 presidents in 11 days, supermarkets looted, savings confiscated. Greece was a member of the European Union. It had adopted the euro. It was backed by the European Central Bank, integrated into the most sophisticated monetary union in human history. Greek citizens believed that being part of the Eurozone made them categorically different from countries that experienced financial crises. How could Greece collapse? It had the euro. It had the ECB. It had treaty obligations from Germany and France. By 2012, Greece had received the largest sovereign bailout in history. GDP contracted by 26%. Youth unemployment reached 60%. Capital controls were imposed. The Eurozone didn't prevent the collapse. It constrained the policy options for responding to it. Lebanon was called the Switzerland of the Middle East. Its banking sector was considered one of the most sophisticated in the region. It survived a 15-year civil war, Israeli invasions, and political assassinations without a banking collapse. Lebanese citizens pointed to this track record as evidence of structural resilience. The system had survived everything. Why would it fail now? It failed now because the things that sustained it, capital inflows from the diaspora, high interest rates funded by new deposits rather than genuine returns, a structure that in any other context would be called a Ponzi scheme, ran out. Venezuela had the largest proven oil reserves on Earth. In 2012, it was still functioning, restaurants open, cars being sold, consumer economy active. Venezuelans were told, and many believed, that the country's oil wealth made it fundamentally different from countries that experienced currency collapse. How could a country with more oil than Saudi Arabia go broke? It went broke because oil wealth without institutional integrity is not wealth. It is a resource curse. The oil was still in the ground in 2018 when the average Venezuelan lost 24 pounds from starvation. The United States has the world's reserve currency. It has the Federal Reserve, considered the most powerful central bank in history. It has the deepest capital markets, the most liquid bond market, and the most sophisticated financial infrastructure ever built. The United States federal debt exceeds $36 trillion. Annual deficits run at approximately $2 trillion. Interest payments on the debt have surpassed $1 trillion annually, exceeding the defense budget. The Congressional Budget Office projects that, under current law, with no recession, no war, no crisis, the debt-to-GDP ratio will exceed 150% by 2050. The last time a major Western democracy sustained a debt-to-GDP ratio above 150% without either defaulting, inflating, or restructuring was never. The mechanism is called exceptionalism bias, and it has a perfect track record of failure. Every country that has experienced a financial collapse believed in the years preceding it that it was structurally exempt from the forces that destroyed other countries. This belief is not irrational. It's based on real differences. Argentina really did have a convertibility law. Greece really was in the Eurozone. Lebanon really did have a resilient banking sector. The United States really does have the world's reserve currency. But the belief confuses advantages with immunity. Having advantages means you can sustain unsustainable policies for longer. It does not mean you can sustain them forever. Reserve currency status doesn't prevent collapse. It delays it, and delay, when it creates complacency, makes the eventual reckoning worse. Every country on this list had a specific reason why we are not like them, and every one of those specific reasons turned out to be a description of the mechanism through which the collapse would be delayed, amplified, and ultimately made more devastating than if the advantage had never existed at all. The Argentine government nationalized $30 billion in private pension funds. These were accounts that workers had contributed to over years and decades, managed by private administrators called AFJPs. The government folded them into the public pension system. It promised benefits would be maintained. They were not maintained in real terms. Government reported inflation, systematically understated actual price increases. Pensions were adjusted based on official inflation, not real inflation. The purchasing power of pension payments eroded year after year. The government didn't steal the pensions. It redefined what the pensions were worth by redefining how inflation was measured. The promise was kept. The value behind it was not. The fifth lie is the last one told before the doors close. It is the lie about deposit insurance, about pension guarantees, about the safety net that is supposed to catch you. It is the promise that even if everything else fails, your money, the money you saved, the money you sacrificed present consumption to accumulate, is protected. European deposit insurance guaranteed deposits up to 100,000 euros. This guarantee held in Cyprus. Deposits under 100,000 euros were not touched, but 47.5% of deposits above that threshold at Bank of Cyprus were seized. These were not billionaires. They were small business owners, retirees who had sold property and held the proceeds temporarily, expatriates with savings from decades of work. The guarantee protected. It also defined the line above which confiscation was legal. The insurance was not a floor beneath which you could not fall. It was a ceiling above which the government could take everything. The Argentine government nationalized $30 billion in private pension funds. These were accounts that workers had contributed to over years and decades, managed by private administrators called AFJPs. The government folded them into the public pension system. It promised benefits would be maintained. They were not maintained in real terms. Government reported inflation, systematically understated actual price increases. Pensions were adjusted based on official inflation, not real inflation. The purchasing power of pension payments eroded year after year. The government didn't steal the pensions. It redefined what the pensions were worth by redefining how inflation was measured. The promise was kept. The value behind it was not. The Hungarian government gave citizens a choice: transfer their private pension savings into the state pension system or lose government pension benefits entirely. Approximately $14 billion in private pension assets were transferred to the state. The government used the funds to reduce the budget deficit. Citizens were told their retirement was now more secure in government hands. The Polish government transferred approximately 51.5% of assets held in private pension funds to the state social security system. The transferred assets consisted primarily of government bonds. The government effectively canceled its own debt by seizing the pension funds that held it. This reduced Poland's public debt by approximately 8% of GDP overnight, not by paying it, but by erasing the creditor. The Social Security Trust Fund holds approximately $2.7 trillion in special issue treasury bonds. These are IOUs from the government to itself. The CBO projects the trust fund will be depleted by approximately 2033 to 2035, at which point benefits would be automatically cut by 20 to 25% under current law. Discussions about means testing Social Security, raising the retirement age, or modifying benefit calculations have been ongoing for decades without resolution. The mechanism is temporal: deposit insurance, pension guarantees, Social Security promises. These are all commitments made by a present government to be honored by a future government, funded by a future economy that may or may not exist, as assumed. The promise is made when it's cheap to make. It is broken when it becomes expensive to keep. And it is always broken in the same way, not through dramatic repudiation, but through redefinition. The promise technically holds. The value behind it is quietly drained through inflation. Adjustment tricks means testing, eligibility changes, tax treatment modifications, or outright seizure dressed up as reform. No democratic government has ever stood before its citizens and said, "We are taking your savings." They say we are reforming the system for long-term sustainability. The vocabulary of protection is identical to the vocabulary of confiscation, and that is not an accident. The five lies are not independent. They are sequential. They form a cascade, and the sequence is nearly identical in every case. First, the inflation is temporary. Buy time. Second, the currency is sound. Maintain confidence. Third, the banks are stable. Prevent withdrawal. Fourth, we are not like them. Prevent capital flight. Fifth, your savings are protected. Prevent panic. Each lie buys time. Each lie delays the recognition of reality. And each lie makes the eventual reckoning worse, because the longer people believe, the deeper they commit to the system that is failing. The lies are not a conspiracy. They are an immune response. A system under existential stress produces reassurance, the way a body under stress produces adrenaline automatically without conscious decision, because the alternative is immediate collapse. But adrenaline is a short-term solution. It allows you to run. It does not allow you to heal. And when the adrenaline wears off, the damage that was masked becomes apparent all at once. Since 1900, 68 sovereign debt crises, 58 currency crises, scores of banking collapses, affecting countries on every continent. In every single case, these five lies preceded the collapse. In every single case, the middle class was told to trust the system. In every single case, the middle class paid the highest price. The statistical probability that an average citizen in an average country will live through at least one major financial crisis in their adult lifetime, approximately 1 in 3. And yet, financial planning, government policy, and cultural messaging all operate as though collapse is a theoretical impossibility. It's now 2026. Hassan still lives in Beirut. His apartment is worth a fraction of what he paid. His car sits in the garage most days. Fuel is too expensive. His bank account still shows a number, but the number means nothing. His company downsized. He works freelance now, billing in dollars when he can, accepting whatever he can get when he can't. He is not destitute. He's not homeless. He's not among the worst off. But he has learned something that cannot be unlearned. Every lie he was told, everyone, had been told before. In the same words, in the same sequence, to other people in other countries who also believed they were different. He didn't lack intelligence. He didn't lack education. He lacked pattern recognition. He didn't know the lies had names because no one had shown him the autopsy reports. The five lies are being told right now, somewhere. They are always being told somewhere. The question is not whether they're being told. The question is whether you can hear them. This channel doesn't predict the future. It dissects the past so that patterns become visible before they become personal. If that kind of clarity matters to you, subscribing is the simplest way to stay informed.